what'll get you the best rate is a step down prepayment. So in your first year, if you prepay the loan, it'll be 10% of the loan amount. In the second year, it'll drop to 9%, third year to 8%. And so it's a declining prepayment by 1%. And so it's basically designed to keep the loan around for 10 years. That's what'll get you the best rate. If you start wanting to, make it more like a 5-year, that'll affect the rate, but it can be done. And so if you have to think about the prepayment, but there's two ways you can lower your rate outside of, waiting the full 35-year term. So one is a loan mod. So if rates drop, say you locked at 550 and rates go to 350, we are able to do a loan mod where, you'll keep everything about your loan is the same except the rate. Now, we do issue a new Ginnie Mae security. So every HUD loan is a Ginnie Mae security, just to put it. And it becomes a security once you have the insurance backing it, right? And then on Wall Street, these loans get pulled together and sold to investors.
Cortney, thanks for taking the time.
Hey, thank you. Glad to be
here. You
here.
are the FHA loan originator for Berkadia out of the St. Louis office. You work nationwide. You've been in the business for 5 years, and you've done $375 million worth of loans over 5 years. So very impressive track record over a relatively short amount of time, even though you've been in the business for a lot longer than 5 years. Can you give us just a quick background on what you do today with Berkadia?
Sure. So the last 5 years I've been with Berkadia, and I've been a commercial loan originator, but I began my career in 2003 as an FHA underwriter, right? So started very entry level and just kind of worked my way up. And actually I was thinking origination wasn't on my radar at all. I was somewhat intimidated by it. But in 2019, I decided to make that jump. And so, the last 5 years, that's all I've been focused on. And like you said, I've originated about $375 million in loans. But in my underwriting career, I've probably overseen about $4 billion in loans. So I'm intimately familiar with with FHA programs. There's the multifamily side where they do apartments, affordable housing, but there's also the senior housing side where we're doing skilled nursing, assisted living, and some independent.
The $4 billion obviously didn't happen overnight. So I'd love to hear where you started, kind of where you're from, and how you got introduced to just the world of commercial real estate.
Sure. So it's actually a little bit of luck. When I graduated college, I moved to DC, and I just needed a job, but I started in finance. My wife, who wasn't my wife at the time, but she got pregnant, and we decided to move back to St. Louis just to be closer to family and have that support. So when I moved back to St. Louis, I was applying for jobs that said financial analyst. Anything that said financial, I sent my resume and cover letter too. And one of the companies was Love Funding Corporation, which is actually no longer existence, but it was owned by Heartland Bank, which is a local bank that was bought by Midland States Bank. And so I started there in 2003. And like I said, it was completely entry level. I really knew nothing about real estate at the time. I remember they didn't have a formal training program. So when I got there, they sent me to these, 101 introduction to commercial real estate courses, which, so that was my introduction into this world. But like I say, it was actually luck. But I've just been kind of interested in real estate. I bought my first house in DC in 2003, and that house, that market was just crazy, but it doubled in value. And so when I moved back to St. Louis, we were actually able to buy our first investment property. And so I've just had that interest in real estate and investment properties and just wanting to have some passive income. So when I went to Love Funding and I found out what the job was, I was super excited. I actually took a pay cut to be part of the organization, but that's where I was able to kind of just jump in. And it was a privately held company. It was a smaller shop. And so it just gave me exposure basically to all the deals that they were doing, which was a little bit of everything. So some new construction, some acquisition, some refinance, and some healthcare loans. And so I don't know, I think a lot, like when I tell my kids about what I do, I don't think they think it's very exciting. But for me, it is actually very exciting. Like the opportunity to look at deals, to structure deals, to travel, to actually inspect the real estate. I actually just love all that, right? And so my major in school was math and econ, and so that problem solving, analytical. I mean, that's how my brain is wired, and so this actually suits me very well.
Before you got on the origination side and you were more on the underwriting side, would you say that was more of a science and now it's more of an art where like now you need to really focus on the story, the narrative of the asset and not just the numbers? Is that accurate to say?
I think it's a little bit of art in both scenarios. Like as an underwriter, you're assessing risk and you want to make sure you're not doing a loan that could, put the company at risk, put yourself as an underwriter at risk. But there's some fine lines that you just don't cross. But then sometimes there's some gray. And so I feel like that's where the little bit of the, where it's not quite as science, where you just kind of have to think and you present your argument. It may or may not be accepted, but definitely on the origination side, it's more. I think it's more. Certainly, there's some science because I mean, there are rules and you just have to follow those. But I just think sometimes you have to think outside the box, and usually there's a way to get things done, right? That's not maybe the traditional way of that most folks are used to. I wish like an example was coming to mind that I could give you, but. No, there's certainly, one good example would be like when you get a market study for a new construction deal. There's all these assumptions that go into it. The households, population growth, renter demand, affordability. What can renters afford? And then they'll make projections like how that's going to grow over the next 3 to 5 years. That is definitely art, right? Because it's based on data, but it's still like their best guess. And I could go to 3 different market study firms and get 3 different answers on what the supply and demand for that market or for that particular project is. So I guess to answer your question, it's always a little bit of both, no matter what side you're on. And the goal is obviously to get deals done, but to be responsible. And we don't want to make headlines for doing anything, call it illegal, crazy, or just unethical. So,
And as far as I know, Berkadia has never made any headlines. I've never seen you guys in the news for anything.
And you won't. And like if you look at, well, especially the loans I'm focused on, FHA, I mean, the default rate it's not zero, but it is like less than 1%. So like pretty much if you're taking the time to go through a HUD loan, you're serious because these are longer term loans. Like we'll do a 35-year term or a 40-year term if it's new construction. And so I don't know. We've run into some issues where maybe things are misrepresented, but it's going to come out in the wash between underwriting, origination, and then deals. So you know how HUD works, where the lender is like the delegated underwriter. So the lender has authority to basically put the whole deal together, and then they submit it for HUD to review. And HUD is not supposed to change anything. They're supposed to review it. And then they review it, and then they issue a commitment to insure. So HUD isn't actually the lender. They're more of like, they're providing the insurance, but the insurance makes it less risky to the lender or whoever is buying that paper, right? Because it's basically guaranteed by the full faith and credit of the United States government. So that's why a HUD loan actually, because of that mortgage insurance, is actually going to be priced, significantly lower than most other sources. So if you look at Fannie and Freddie, and this varies, but and it's actually gotten a little tighter, the spread difference. But HUD used to be maybe 100 or 125 basis points on those, where that it's shortened, but still HUD's maybe like 50 to 75 basis points better. But that can depend on a number of things like the affordability of the project, if it's green or not, if it has some green certification.
I think a good place for us to go now would be what FHA lending is. And if that's Fannie Freddie HUD, then what the process looks like for all of them. Because like for HUD, you kind of mentioned the lender is going through the entire process, and then HUD is reviewing and ensuring that debt.
Right.
Is it similar for Fannie and Freddie as well?
It's similar. The biggest complaint you'll hear about HUD is timing. And so a HUD loan is going to take probably, on average, 4 to 6 months to close. And this is a refi. If you get into new construction, it's probably more like 9 to 12 months to close. But if you look at Fannie and Freddie, and I'm not really sure how they do this, but they can close a loan inside of 90 days. I mean, actually, they could probably do it in 60 if you're really pushing and, running on all cylinders. The underwriting model is similar because we have underwriters and they'll put it together and then you submit it to the agencies and they're sort of reviewing everything and then, they'll spit out their commitment. So it's the same. And obviously, I'm more on the FHA side, so I can speak to that a lot better. But that's like why I'm jealous of Fannie and Freddie, because it's really because of the timing, not because of the leverage. I mean, they're going to have a little bit higher debt coverage and a lower loan to value. So where HUD, I can get to typically, if it's a cash out deal, I can get to 80%. Actually, I can get to 85%, like on a true transaction cost, taking out the cost. But with Fannie and Freddie, I'm probably, more like 65 to 75% loan to value, and in that 125 debt cover, where HUD for a market rate property is like 11176. We actually just got some good news that they're planning to lower the debt coverage for market rate properties. It's not a huge bump, but everything kind of helps in this market.
So before we started recording, you mentioned that a lot of what you look at today is kind of debt cover restrained in terms of the loan proceeds. Is that HUD responding to that, like seeing that in the market? And then is HUD an entity that's able to respond to market conditions like that, or is this just totally unrelated?
No, the change really, so where I used to see loans limited by value, and there's 3 criteria really with HUD. So there's what the loan can support, that's the debt service limit. Then there's a loan to value component. And then there's a third one, which is called statutory limits. So HUD doesn't want to be in the business. I'd say it like this, building luxury apartments. So when you get to like that 300,000 a door, new construction, HUD's not going to be, HUD just can't go that high because there's statutory limits based on size and the area. So the size of the apartment, so number of bedrooms, but also the area. So we can go higher on that stat limit if we're like in areas, New York or California. But generally, HUD isn't meant to be that super high-end luxury. But we do, that's another myth that, HUD is only like Section 8 or low-income housing. It's all properties, but we just don't get into like the super high-end, let's say. But the reason we're debt service limited now is strictly because of rates. And so there's been no change like in the HUD policy. But if you look like right when COVID hit, our loans were priced over the 10-year treasury. It's usually spread over the 10-year. And when COVID hit, the 10-year treasury dropped like below 1%, for a while. And so basically every loan, the debt coverage limit never came into play because the rate was so low that we were always able to really get max proceeds. So now you flash forward today where the 10 years back in like that 4% range. And so when rates were in the COVID level, say of just 0.5 or 1%, we could do a loan, like the all-in rate would be like 2.5, 2.25. Some loans I saw rate locked. And so, I mean, that's just fantastic for the borrower, for the property. But now we're locking more like 5.5 today, and it's very volatile. It changes just based on a 10-year bouncing all around. But that's really what's driving across all the programs, the lower loan proceeds.
And you mentioned like 5.5, for example, today. If someone were to lock that in with HUD, are you able to reprice at any point? Like, are you able to refinance within that 30, 35 years without significant penalties? Or is it always strictly, 30, 35 years. And if you refinance, you're paying, an insane penalty.
So generally on that, and then you can structure this in multiple ways, but generally what'll get you the best rate is a step down prepayment. So in your first year, if you prepay the loan, it'll be 10% of the loan amount. In the second year, it'll drop to 9%, third year to 8. And so it's a declining prepayment by 1%. And so it's basically designed to keep the loan around for 10 years. That's what'll get you the best rate. If you start wanting to, make it more like a 5-year, that'll affect the rate, but it can be done. And so if you have to think about the prepayment, but there's two ways you can lower your rate outside of, waiting the full 35-year term. So one is a loan mod. So if rates drop, say you locked at 550 and rates go to 350, we are able to do a loan mod where, you'll keep everything about your loan is the same except the rate. Now, we do issue a new Ginnie Mae security. So every HUD loan is a Ginnie Mae security, just to put it, and it becomes a security once you have the insurance backing it, right? And then on Wall Street, these loans get pulled together and sold to investors.
So with the loan mod, someone can approach you in the middle of their term with HUD, and then you can add additional debt to the asset, or how does
So
that
on a
work?
loan mod, we can't add any
Okay.
debt, but we can lower the rate. But what I was saying is when you do a loan mod, you do have to create a new Ginnie Mae security. So the prepayment penalty will be tripped. But if the rate is, so in the scenario where you have a 550 rate and I go to 350, because today's rate is 350, but say you have a 3% prepayment penalty, what we're able to do is cover your prepayment for you inside the rate. So instead of you getting a 350 rate, which you'd rather have, but because of your prepayment penalty, you'll probably end up, say, with a 375 rate, right? But still better than what your current rate is. And you can do that pretty much any time that the numbers work out. The second way with HUD is called called a streamlined refinance or a 223A7. And so in that scenario, what you can do is it's a refinance, but the rate has to be lower and you have to create debt service savings to be eligible. But if you do create that, then we can take the loan amount, so it'll have amortized down. We can take the loan amount back to the original principal balance. So that gives money for like repairs, cover the transaction costs, and the prepayment will be tripped in that scenario too. So if those proceeds can cover the prepayment, great. If not, then we'll do the same thing where we'll try to build the cost of the prepayment into the rate. And generally, as long as there's still some debt service savings, the borrower will do it because they're better off. So those are the two ways I think that HUD offers to quickly refinance your loan. And there is very minimal cost. So a loan mod, there really is no cost except for your the borrower's legal fees they'd have to pay. And then on an A7, we don't have to do an appraisal. We don't have to do an environmental report. In some cases, we will do a new PCNA just to kind of check the condition of the property, make sure everything's good, and see if we need to reset the reserves. Because on HUD, every deal, we have reserves for capital replacements, and we'll look at a 20-year schedule to see how much money needs to go into that account. So the A7, I may need to do a PCNA just to make sure, there's no issues with the capital. But those are, relatively cheap and fast ways to get your existing loan refinanced. And then if you want to cash out refinance, you're just going to have to do a whole new, what we call a 223F.
So speaking of the costs, I think that's an important topic to touch on because from my perspective or anyone I talk to, the reason why they don't go to HUD, even though the terms are favorable, would be cost related or time related. Those are really the two big pieces that I hear or see. So what deal size would you say is ideal to go in the HUD direction in terms of value? And then what can someone expect from you and then the entire process in terms of timing, costs, things like that?
So a typical deal size, I think if you're below $1 million, honestly though, there isn't a limit. So I can't really turn someone down if they want to do a HUD loan on a 5-unit property. But under $1 million, when you look at the cost of the third-party reports, the HUD fees, the lender fees. In my opinion, it doesn't make much sense to go the HUD route, right? And so in that scenario, you may want to look at more like a small balance Fannie or Freddie loan. And because the cost to do a $1 million loan on the HUDs is the same as do a $100 million loan, right? I'm going to need the appraisal. I'm going to need a PCNA. I'm going to need an environmental report. HUD charges a fee to examine the application, which is 0.3% of the loan. So that's another cost you have to think about. Now, all these are mortgageable and can fit in the loan, but I just think if you're below a million, I don't want to say the wrong thing, but generally I would probably steer you to another source just because of the cost. And if like in terms of the reports, HUD adds a layer of complexity, I would say. It's not necessarily a bad thing, but there's just more work for some of the third parties to do. So generally the cost for a HUD appraisal, could be maybe $1,000 more than the traditional bank appraisal. Also on the PCNA, HUD is very concerned about accessibility. And so, and fair housing laws, and it's strange, but you'll see properties, recently built where they actually aren't in compliance with the law. Now they've gotten their certificate of occupancy and the city says they're okay. But when we go in there and we look at like door widths or thresholds, height of the thermostats, is the mailbox accessible to someone? Can someone in a wheelchair reach that top mailbox? We just find those things even on new construction projects. So at HUD, it's a big deal, and we can't just sort of turn the other way when it comes to accessibility of those things. So HUD can actually add more costs because of that, because we're going to have to correct those items.
Generally speaking, can those types of repairs, like for example, if you need doorways to be wider, can you do that post-closing, or does that need to be done before closing on the loan?
So HUD, we have two types of repairs: critical repairs, which we want those done before the loan closes. But something like the thresholds or widening doorways, those would fall into non-critical. And so you would have 12 months from closing to get those done. Now, with COVID, we were seeing like some delays in just, supply chain issues, not being able to get repairs done. And so I've seen where HUD may give an extension for that, but they really don't like to do that. So generally you can have a year though to complete repairs post-closing, as long as they're not, life safety.
Got it. In the apartment world today, we're in a somewhat challenging environment where maybe someone that needs to refinance, maybe doing a cash in refinance or a cash neutral refinance. If someone in that position brings you a deal and I don't know, let's say their loan is maturing 6 months from now, what's the process look like from your end for you to give them a reasonable value of where you think the property valuation and then the debt is going to come in? Or is that a process of you sending it out to different parties and getting it back?
So generally when I'm pricing a deal, I'll ask for, if it's available, last 3 years of financial statements and a trailing 12, right? A lot of times all I'll get is a trailing 12, but at least that gives me 12 months of data to see how the property is performing. With that, I also ask for a rent roll, and then I'll ask for, just information on the existing debt. And so I'll look at their cash flow. So like if they're 100% occupied, I'm going to hit them with a vacancy of 7% for a market rate property. It's just because I have to, and if I look through the expenses and they're kind of light, I may, like, say if it's owner managed or something, I'll probably add a market like management fee. And so try to get the revenue and expenses as close to like a normal, operator as I can. And then we'll look, the cap rate is somewhat of a guess. Usually I'm relying on actual, sales from the appraiser. But at Berkadia, we're one of the largest non-bank commercial servicers in the country, and we service over like 400 billion in loans. And so we actually get a lot of data on, financials and rent rolls, which can be helpful. And we actually have a lot of like comps, expense comps, some land comps and rent comps. So I'll use that to, get a good guess of what the cap rate should be. And I tend to want to be somewhat conservative. I'd rather be conservative and outperform than aggressive and underperform. So that's how I'll come up with it. And we'll look at the deal and kind of see if it works. I mean, I'm not, I think we're going to start to see more of these, like where people have to bring cash into the deal. Luckily, at least the deals I'm looking at, I haven't seen that yet where, well, it may be a little, but it's not a significant, like they got to bring $20 million to close this, $10 million loan, something like that. But that may be coming down the pipe for us, because there was an economist who spoke, and they were just talking about all the maturities that are coming up in this year, but all the way to like 2028. So like in the commercial real estate sector, there's over, and this is all not just multifamily, but there's like close to $1 trillion in debt that matures. And like 25% of that is apartments or multifamily. So I think some folks will try to kick the can down the road a little bit so they can exercise their extensions. It might be a 1 year or 2 year extension. But I think soon we're going to see where that's not an option anymore. And so folks are going to have to refi and basically, kind of what we were talking about earlier, insurance costs and real estate taxes are really hurting the net operating income. And so that ultimately is hurting the value. So, where things are headed, it's going to be pretty interesting, I think, over the next couple of years with all this debt coming due. But for apartments, I'm not really as worried. Like I would have more concern for the office world, where so many people still haven't gone back to work. So those NOIs are down significantly, which means those values are down significantly. And then people just have there's like so much supply now. So I think even the new rentals are probably not at that, price per square foot they really want to see. And so that market is probably going to get hit pretty hard. And I mean, don't ask me to predict when, but I think it's coming for the office space. The apartment, though, the leverage we've been doing, like in the great financial crisis, leverage was crazy high, like 100% financing. What we're in right now, even though rates are higher, like if you got a HUD loan, we lent at 80% loan to value. If you got a life company loan, that was like a 50% loan to value. And if it was a Fannie Freddie, say you're at 75. So they're leveraged, I think, to be able to handle a refinance in the future, where office, I don't think will be, but we shall see.
With HUD, are they mandated to always be backing these multifamily loans? So like, in other words, if the capital markets for office dry up with the existence of HUD, would that not happen in multifamily, or am I thinking about this wrong?
So in multifamily, yeah, that's kind of what like Fannie and Freddie and HUD are there for. So, and they're, I guess you call them countercyclical. That's what I think the terminology is. But and like 2008 would be a great example where there wasn't a lot of liquidity in the markets. HUD and the GSEs really stepped up, and you saw their volume, increase pretty significantly during that time. So yes, I think to answer your question, HUD is definitely there to sort of boost liquidity and help the capital markets.
Got it. That makes a lot of sense. Just going back to valuation real quick. If I send you a deal or someone sends you a deal, you're using access that you have at Berkadia plus your own market knowledge to come up with some sort of idea on where you think value is going to come in, where you think the debt terms will come in, or you're getting quotes from lenders or from HUD, however that may look.
Right.
But the actual value from the lender's perspective is going to come from the appraisal.
Ultimately, correct.
And then there's a little bit of back and forth with the appraiser lender once the draft is out, correct?
Always.
And and that back and forth is just because there's three approaches: cost, sales, and income for that total value. So when that back and forth happens, is it the lender just kind of saying, we need to give more weight to the comps or more weight to the income, or what does that typically look like?
Yeah. And so an originator, so me, I shouldn't be involved in any of those discussions, obviously. But the underwriter, when that appraisal comes in, he or she will probably know right away, oh, this isn't where we were expecting. And so they kind of scrub it. And really, I think, first you're looking for any errors or things that might jump out, obviously. Then you want to kind of look like at the comps to say, are these good comps? Are these the best sort of representative sample of the market? And then as they conclude rents or expenses, there's always a range, right? So there'll be like a comparable range, and really, basically they need to conclude somewhere in the middle of that. But who's to say it should be the high end or the low end, right? And so I think as if you're an underwriter and you have an argument, then you will go back to the appraiser and say, hey, based on the tax abatement here, and they're saving so much in taxes, maybe that warrants a lower cap rate, right? Closer to the lower end of the range. Or, if payroll, we're looking at the comps and it's in that. So that's how I think we can kind of tweak. You can't obviously commit fraud, or you can't tell an appraiser what to put, but you can interpret the data and then make suggestions on how it should be. And they either agree or they don't, but that's how we sort of, finesse the appraisal to get it where we believe it should be.
The underwriter, they're going to do that, like whether it's in favor or not for the property. Like, for example, if the appraiser used a cap rate that's too low, will the underwriter say, no, I think it should be 6.5 instead of 6? Or is the underwriter trying to push the value as much as they can, if that makes sense?
Right. No, I mean, an underwriter, I think generally what happens is they kind of know what the expectations are, like based on the engagement letter, where the deal was sized, how much debt we need to take out, and the cost of the loan. And so I think in some ways they know that. And so they know whether they need to push or not. And I think the answer is yes, though. If the cap rate is too low, they should change it. Because what happens if they don't, HUD's going to review it, and then they may change it, and it'll look bad. It'll reflect poorly on the underwriter for not catching it. Generally, I don't know that we're ever trying to lower the value per se, but I think it could like if you see a glaring error and it's unfortunately not in our favor, you still need to call that out. So because I mean, you just don't we're a MAP approved lender, and if any of our loans go bad or have an issue, then you get into like this what is this, like the enforcement division of HUD, where you don't want to be, and it could put the lender at risk, and also that MAP underwriter, because he's approved by HUD. And so if that MAP underwriter loses their license, like they basically lost their career, right? And so no one's gonna jeopardize that for one loan. But yeah, there is definitely some art that goes on with the appraisal. Like when I see a range, I'm like, okay, there's a range. We can go a little higher. This is me as an originator. And similar as an underwriter, you're just kind of looking to say, hey, it's not really a stretch if we were to, move the cap rate 10 basis points based on your comps. And the appraiser can agree or not agree, but that's the kind of discussions that happen once that report comes in.
Sure. Yeah, that makes a lot of sense. I've always been curious about that, because I know for the most part, the originator is fighting for the client, and the originator is fighting for that value. So that
Right.
separation makes a lot of sense. So you don't have that bias with the underwriter, and everything's being done the way it should. So you have, obviously, as an originator, you have a lot of moving parts. You have clients, prospective clients, you have underwriters, you have third parties, and you have HUD and all these other things that you're trying to move in the same direction. How do you manage your workflow and just all these moving pieces?
Well, like for me as an originator, like all my deals, like they're my deals and I want to see them succeed. So selfishly, I'm excited to work with all these folks, right? And there's different stages. So I'll be with the underwriter first. And it's more like the first step is just getting the deal into HUD. So we order the thirds. We start collecting all the information on the property, information on the borrower, information on the management company, assemble that, And so that's like the first piece where I'm all over the underwriter. How we doing? Did you get the reports? How they look? And just annoying. I hope I'm not annoying, but I probably am annoying the crap out of them. And then when it gets to HUD, correspondence now has to be between the underwriter and HUD. So I'm still sort of leaning on the underwriter, like, what'd you hear? Like, and then if we get something from HUD, those you have to address immediately. So if HUD issues any comments, usually that'll come with a window of time to respond. And if you don't respond within that time frame, it's usually like 5 business days, you run the risk of them sending your application back, so that's obviously you don't want, because there's a lot of money that goes into getting that application submitted, and you don't want to lose the borrower's funds. That'll jeopardize the relation. That's all bad, right? We definitely want to respond timely, and so that's where I'll be all over the borrower. Hey, I need this and I need it now, and I'll be all over the underwriter as well. HUD, I can't really influence, and there's a bright line that I need to maintain, obviously. So, but the next sort of stage is when we get into close. So HUD issues that firm commitment. So now we get into rate locking and closing, and that's when I'll be all over closing to make sure everything's rolling. So, like all that, it's sort of different folks to manage, but selfishly, it's all for my benefit, and so I'm happy to do that. I love that piece of it. I don't know how others might feel about me during the process, but generally I'm trying to be helpful just to make sure things are done quickly, accurately, and we're sort of meeting expectations of the borrower. But yeah, it's definitely a lot of people to manage, and it can be stressful when, because you don't always get information that's favorable or positive to the deal, right? And so managing expectations is a big piece. One of the biggest things I feel like my job is for the borrower is to show them where the boogeyman could jump out and derail this whole deal, right? Because if something does come out of the reports and they're sort of blindsided, even though it's not really my fault, they're sort of mad at me for not telling them about it or making them aware about it. And so that pressure or that negative energy kind of comes to me, and I just always want to avoid that when possible. So that's kind of like where I'm always thinking ahead, like what could go wrong? So usually I'm pretty good at that, but there still are some things that can jump out and surprise you.
Makes sense. And there is only so much that you can try to figure out before the reports and all
Right.
that are ordered.
Right.
So we like to end each show with what we call a hole-in-one, which would be your greatest piece of advice that someone can implement in either their life or career today. But before we do the hole-in-one, is there anything else you think we should cover about the FHA market or just what you have going on at Bricadia in general?
Well, I mean, I think in general, folks should consider FHA financing. I mean, obviously I'm biased because that's what I've been doing, my whole career. But in terms of leverage, I think it's the longest term, the highest leverage that you're going to see in the market between the banks, Fannie, Freddie, life company, CMBS. HUD is going to get to the highest leverage. And I think there's one of the things that really used to turn borrowers off is HUD only used to allow distributions of cash twice a year. And so for a lot of folks, that just doesn't work. They want to take it every month as it's earned. But HUD recently changed that rule to allow for that. So I think that's actually helped borrowers, at least think about HUD. I think also in terms of like the prepayment we talked about, the step down prepayment can be a lot better than yield maintenance or defeasance. And, it's non-recourse. So I think that's important, but the agencies are non-recourse as well. So I just wanted to say that for HUD, like people should consider it. And there is maybe a little extra paperwork, but at the end of the day, like I said, it's going to be a great loan. And then you have opportunities to refinance it, pretty easy. And obviously, in terms of Bricadia, we're the number one HUD lender in the country. Well, that was our ranking last year, right? And we were the number one, like in terms of new construction, in terms of, I believe acquisition and refinance, but I need to double check. But just overall loan volume, we were definitely number one. And we're number one overall. Like if you look at agency and HUD combined, we're number one. So I'm proud of that, to be part of the team. There really isn't any product type that we can't at least make a quote. So if you've got a hotel, if you've got student housing, I know you've got some self-storage, stuff like that. We have the expertise to be able to quote it. And we've also got some equity partners. So folks coming in to help, build the capital stack. So I think, the only plug I would make for Bracadia is just keep us in mind, because we are definitely serious about commercial real estate.
Thanks for sharing that. And after we get the hole-in-one, I'll get your contact information as well. And we'll include that in the description and all that. And also appreciate you sharing the piece on distributions. I didn't know that. I thought it was once or twice a year. So the fact that it can be potentially quarterly or maybe even monthly, that's huge.
There one other rule that they just changed. So if you built if you built a multifamily project and you use just conventional funds like a bank to build it, you normally would have to wait 3 years before you could come to refinance for HUD. They did away with that rule. So now if you build it conventionally, basically you can come to HUD as soon as your property's stabilized. And so that, I think, is actually driving a lot more business to HUD. It's actually one of the sort of core audiences I'm targeting is projects that have been built, but, are close to stabilization, because they're good candidates and they need a permanent loan for, to take out the construction debt. So I think that was really another favorable rule that HUD passed that's really, helping promote more lending and more development of housing.
Makes sense. Yeah. And that's another great point that I wasn't aware of. Hole-in-one. I know it's a tough question.
Hole-in-one. That's a question like my wife would ask me, how am I feeling? What am I thinking about? But what was the question?
Your greatest piece of advice that someone can take away and implement in either their life, business, career, anything. Just like an actionable piece of advice someone could take away from this.
In general, like just kind of looking at my career, I definitely think it's kind of good to have some mentors or people you can talk to, because like my ceiling was I won't say it was low, but like I just wasn't seeing like how far I could go in my career. I was thinking more like I'm going to be an underwriter for life, right? And I think my ceiling really kind of changed when I went to grad school, and then I started thinking like more entrepreneurial. And so I think having mentors is important, just folks to kind of help you see different perspectives. Obviously, you need to work hard. And working hard is a big piece of it, but my career actually has been on like luck and timing in some ways too. So, but one takeaway, I don't know. That's a tough one.
The mentor one was a good one if you want to run with that. But I would ask you if you want to use that as your hole-in-one. So should someone find a mentor that's like maybe 5 years ahead of them, 10 years ahead of them, or like what worked for you in terms of some of the people that have helped you along the way?
Yeah. So, I mean, my mentor, a lot of times it's been my bosses who've been, and so they're older, but they're sort of have an interest in my career and they want to see me do well. And they're just like pushing me to do things outside of my comfort zone, right? And like, even like I was saying, as an underwriter, I was comfortable it was a good living. I was, when I was a chief underwriter, I was able to pay all my bills, save some money. Like, so that was fine. But, I love what I do now. And so now to be on the sales side and, you have to go out and make these relationships. So I'm losing my thought, but I think, a mentor is important. What I see from when I work now, I'm 47 years old, right? So I've been working 24 years, right? And my daughter would look at my path and she's not interested in that at all. Like she's just not in they don't even hold, like my first job at Love Funding, I was there 12 years. Next job, I was there 4 years, and I've been at Berkadia now for 5 years. Like I'm thinking she won't make it more than 2 years at her current role. And so I do think, really, if you're getting advice, you want to be learning always, right? And do things that allow you to learn, and don't focus so much on the money, because as you learn and grow, that's what makes you more valuable. And the money's just sort of going to come inevitably from that. And I think the other thing, advice I would give to folks is you got to have something in your life that makes you smile, that makes you happy, right? And like, so for me, I love to travel. Like I love to, every time I get on the plane, it just feels like an adventure. I'm going somewhere. And so with commercial real estate, I've been able to do that all across the country. But like every year, me and my family, we take a trip. Like we were just in Italy, which I would say is one of my favorite places on earth in terms of food and just, atmosphere, walkability. Before that, I probably would have said it was Croatia. But every trip just kind of rejuvenates me and gets me, ready to get back to the grind. And so everybody's got to have something that, like, it just can't be all work all the time. You got to have something that helps you sort of just smile, relax, and, feel at peace, I guess, with your heart and everything. So that would be my advice. And I know it's different for everybody. Like some folks, I think they love to ski, so they're going every year. Some folks love to fish. For me, like I said, I like to travel, and I like being in hotels and trying different food, just walking around a city that I've never been to. It's fun to me. So like, I love doing more of that, and I make time to do that every year. And somehow that just continues to help my attitude. And if my attitude is good, then, work is good, and it sort of trickles into everything else in my life. So I'd say a mentor, number one, have that, and then have something that is for you that makes you happy. And that's how you can kind of just keep going in this grind of life.
Thank you so much for sharing that. I do appreciate it. And I think that's great advice, even though you came up with it on the spot. I think it's
I
awesome
should
advice.
have thought a little bit more about that question.
That was great.
Yeah.
And the piece about finding something that really brings you joy hit home for me, because that's something that I've been thinking about a lot lately. Like you said, the grind of life and just having your head down working. At some point, that no longer works, and you need some other stuff too. So thanks for sharing that. Really appreciate it. And thanks for your time.
No, thanks for having me.
Yeah, appreciate it.
Thanks.